Hello. In this brief video, I'll be discussing some of the contents of Chapter 3 in the text. And then next week, we'll be covering the second part of Chapter 3. Several changes as a result of the new tax law this year. And it was enacted, of course, the Tax Cut and Jobs Act of 2017. And it took effect, much of it, in 2018. And so I wanted to draw our attention to a few of the most really important elements of the chapter, and then I suggested you, in addition to reading the chapter, review the rest of the PowerPoint slides for the first half of Chapter 3. But there were some that I did want to draw special attention to for you. In computing the tax for Chapter 3, we see the tax formula, and the tax formula really is essentially where we start with gross income, and the IRS defines it very broadly, and then we wind up with our taxable income, after which we apply credits and amounts paid to determine if we have a tax refund or amount due. So it's getting, throughout this course, we'll be getting from gross income down to the tax due or the refund or receivable, and we'll be filling in additional details in each of these line items. But this is fundamentally the basic formula that we'll be using. Income less exclusions, which we'll talk about, and gives gross income, and then we'll take out any deductions for AGI, and we'll talk about the importance of deductions for AGI briefly. And then we wind up with adjusted gross income, and this concept of adjusted gross income is really unique to individual income taxation on Form 1040. Another thing I want to point out that is many of the changes as a result of the Tax Cut and Jobs Act of 2017 will expire in 2025, and unless legislation is created between now and then to extend them, especially as it applies to this course, which is individual taxation. Many of the changes that relate to corporations, such as the reduction of the corporate income tax to a flat tax of 21%, those are permanent changes. So we'll fill in throughout this course some of the line items with greater detail. All right, so one of the items I wanted to discuss briefly was this partial list of exclusions from gross income for 2018. And a couple of things that come up in recent years, or sometimes students have questions, is of course child support payments are not taxable to the recipient, nor are they tax deductible by the payer. Inheritances are not subject to income tax, and certainly not subject to federal income tax. Some states, a few states, have an inheritance tax on the state level. The gifts received are generally not taxable to the recipient. However, the gifter, if the amount exceeds roughly $15,500 for 2018, must report that gift as taxable income. Scholarship grants, kind of moving over to the right column here. Scholarship grants are generally excluded to the extent they pay for tuitions and books. If those scholarship funds are used for other purposes, then such as room and board, then that income could be taxable, or if those scholarship grants are used for purposes outside of education. And I'll let you review the rest of the list. Workers' compensation benefits are not taxable, although unemployment benefits are taxable. So here's a partial list of gross income items. And of particular note are alimony for 2018, hobby income, and again there are certain tests that have to be met to determine whether or not that is income that should be included in gross income. Any premiums paid by your employer for health insurance coverage up to $50,000 is not included income, but any amount over 50,000, premiums for coverage over 50,000 would be included in income. Jury duty fees included as well. A partnership income from K1 would certainly be included. And gambling winnings, of course, are included in income. Gambling losses are not deductible, but they are useful to the extent they can be netted against winnings. So if you had a net loss in gambling for the year, that loss is not deductible, but it could be used to offset any winnings. Punitive damages are included in income. Compensatory damages, however, that is damages to make the plaintiff whole, are not included in income. Illegally gotten funds or embezzled funds are included in income. Dividends are included in income, although they are subject to preferred dividend capital gains rates. But this is a concept I wanted to most emphasize in this video, and that is something we need to remember throughout the course. That is that some deductions are deductible for AGI and some are deductible from AGI for those who itemize. And this distinction is important for a couple of reasons. One is that if a deduction is deductible for AGI, that is, it determines AGI, then those deductions, such as interest on student debt, those deductions will benefit taxpayers who file at itemize or who file as using the standard deduction. So for that reason, deductions for AGI are quite valuable. Another reason deductions for AGI are valuable is that they will, the lower the adjusted gross income, the lower will be the threshold to qualify for many deductions and credits from AGI. So a deduction for AGI may help the taxpayer who itemizes qualify for greater deductions when they itemize their deductions, assuming they do that. And also, as I said, a lower adjusted gross income may help taxpayers qualify for additional tax credits as well. So it's really important. So the adjustments for AGI are often called above the line deductions. So for AGI, I mentioned interest on student loans is one, alimony paid, contributions to a traditional IRA, not a Roth, but a traditional IRA, is a deduction for AGI. That is to say, it reduces your adjusted gross income, as do contributions to health savings accounts. So all of these deductions for AGI or above the line deductions are extremely important because again they lower that critical AGI number, which is used to help determine whether or not the taxpayer qualifies, as I said, for certain itemized deductions, the extent to which they qualify for those deductions, as well as qualifying for certain refundable and non-refundable tax credits. Here are some others where the for AGI number includes qualifying for medical expenses, because medical expenses for the taxpayer who itemizes is deductible to the extent it exceeds 7.5% of adjusted gross income. Well, the lower the adjusted gross income, the more of your medical expenses will be deductible in the event you itemize. Now, deductions from AGI, these are deductions that are available only for taxpayers generally who itemize deductions. So, of course, deductions from AGI would impact, an example of which would be, as I said, 7.5%, those medical expenses that exceed 7.5% of AGI, those are itemized deductions. We'll talk a little bit more, or we'll investigate personal and dependency exemptions for purposes of qualifying for example, a relative as a qualifying relative. As you may know, in 2018 through 2025, the actual for AGI deduction of dependency exemption has gone away. But the concept of dependency exemptions are still important because they help us, as I said, in a variety of areas, including determining whether a relative qualifies as a dependent, a qualifying relative. So here's a partial list of itemized deductions, or we call deductions from AGI. And I'll let you review this in the text as well as in the full PowerPoint. There was a change, by the way, in charitable contributions, 50% overall except 60% for cash contributions to public charitable organizations. And then another big change, of course, was only $10,000 of combined state and local taxes is generally deductible with some exceptions. So the standard deduction then is a sum of really two components: the basic standard deduction, for example, for a single taxpayer or for a married filing joint, and then additional amounts are added for taxpayers over 65 and or blind. So these are the amounts then are $12,000 for 2018 for the standard deduction. So yes, we lost the deduction for personal exemptions and as a result of the 2017 Tax Cuts and Jobs Act, at least until 2025, but we did gain more than that amount lost from the personal exemption in the amount of increase in the standard deduction. So they've gone up significantly, as you can see, from 2017 through 2018. And again, we need to factor in the 4,150 of personal exemptions that are no longer available. And then these are the additional standard deduction amounts that would supplement the standard deduction I just mentioned on the previous slide here. So these are supplemental or additional standard deductions that are available to folks 65 or older and or legally blind. And you can see those have gone up slightly as well. So I encourage you to read, of course, read the chapter. Next week, as I said, we'll go into the rest of chapter 3, and of course review the full set of PowerPoints. Also, just as some administrative notes, as needed, for example, for difficult or challenging problems in your assignments, my plan is to provide some additional support for those assignments that I'll be posting to Blackboard. And then finally, in my phone service is not working properly. I'm not receiving messages properly. So I would recommend that if you need to contact me, to please send me an email. Any questions regarding the information we've discussed in this video, or anything regarding Chapter 3 or the preceding chapter, Chapter 1, please let me know.